Imagine waking up to the news that the Federal Reserve has just slashed interest rates for the first time in 2025. Markets shiver, headlines scream recession, and investors everywhere scramble to understand what just happened. This isn't just another policy tweak, it's a signal. Unemployment has climbed to 4.3%, the highest in 4 years. A shocking revision revealed that nearly 1 million jobs never existed, vanished from the data books overnight. If this déjà vu chills your spine, it should. Because the last time cracks like these appeared in America's economy, they triggered the 2008 financial crisis that wiped out trillions of dollars and scarred a generation. But here's the big question. Is 2025 about to repeat 2008? And more importantly, what does it mean for your money? Stay with me, because this story is history rhyming in real time. Think about it. Inflation stuck at 2.9%, refusing to cool. Job creation is stalling. Central banks are trapped between fighting inflation and avoiding recession. If you invest, save, or simply care about your paycheck, you need to know where this is headed. Because rate cuts aren't just numbers. They decide the future of your mortgage, your credit card bills, your retirement fund, even the stock market you're betting on. History doesn't repeat itself, but it does rhyme. And if 2025 rhymes too closely to 2008, your financial future could be on the line. On September 17, 2025, Jerome Powell stepped onto the podium and delivered the unexpected, a 0.25% rate cut, bringing the Fed's benchmark down to 4.75 to 5%. Officially, Powell cited labor market concerns and progress on inflation. But the real bombshell wasn't in the speech, it was in the data. The Bureau of Labor Statistics admitted it had overcounted jobs by nearly 1 million over the past year. That's not a typo. Almost 1 million jobs simply vanished from the books. Add to that a weak August report of just 142,000 new jobs, and suddenly, the strong U.S. labor market looks fragile. Investors panicked. The Dow Jones jumped 250 points at first, but the S&P 500 and NASDAQ quickly turned red. This wasn't a celebration, it was fear. And if you think that fear is overblown, consider this. Before the 2008 crash, the Fed also cut rates, believing it could engineer a soft landing. Instead, it unleashed the worst recession in decades. Are we watching the opening credits of a sequel? Let's rewind. In 2008, America's economy looked strong on the surface. Unemployment was 5%. The housing market was hot. Banks were lending freely. But beneath the surface, cracks widened. Subprime mortgages collapsed. Credit froze. By 2009, 8.7 million jobs were gone, and unemployment soared to 10%. Now compare that with 2025. Jobs revised down by 1 million. Unemployment rises from 3.8% to 4.3% in just months. Inflation stuck above the target. Global growth is slowing, with the IMF warning of a drag on the UK and European economies. Sound familiar? It should. Even Powell's language, emerging risks to our goals, eerily echoes Ben Bernanke's 2008 assurances that everything was contained. We all know how that turned out. The markets sense it too. Volatility indexes are climbing, bond yields are swinging. UK's FTSE is wobbling under US tariffs and slowing trade. This isn't just an American story. It's global déjà vu. Here's where history saves you. The Great Recession wasn't just chaos, it was a classroom. And the investors who learned its lessons survived and even thrived. Lesson 1. Diversify beyond hype. In 2008, speculative stocks got crushed, but companies selling essentials, utilities, food, healthcare, stayed resilient. In 2025, the same applies. Don't put all your chips on tech. Balance with staples and bonds. Lesson 2. Cash is power. Those who held cash in 2008 bought assets at fire sale prices. With the Fed cutting rates, cash gives you optionality when others panic. Lesson 3. Debt is dangerous. Margin calls wiped out portfolios in the Great Depression in 2008. Today, rising unemployment means over-leveraged households risk collapse. Cut down debt before it cuts you. Lesson 4. Stay disciplined. Fear drives bad decisions. Those who stuck to fundamentals, buying strong companies, holding through the storm, came out richer. The takeaway? Don't fear the cut. Fear the mistakes people make when they panic. The Fed's cut is a flashing warning sign, but it's not destiny, it's a decision point. History shows that crises punish the recklessness and reward the prepared. If you diversify, hold liquidity, manage debt, and stay disciplined, you can not only survive a downturn, but emerge stronger. 2025 doesn't have to be another 2008, but it could be if we ignore the rhymes of history. And that's the story behind the Fed's first cut of 2025, part déjà vu, part warning, part opportunity. But what if I told you this isn't the first time financial chaos reshaped the world? In fact, centuries ago, a pandemic called the Black Death didn't just wipe out lives, it created unexpected millionaires. That's the next episode here on Historian. Subscribe now and let history guide your financial future.